14 of 21 series are aligned with stagflation mild this morning. That is a moderate, but not overwhelming degree of systematic agreement in the framework. The current macro regime is stagflation mild, with a confirmation score of 14 out of 21. In this configuration, the macro regime describes an environment where growth momentum is decelerating at -0.5777, while inflation momentum is accelerating at +0.0081, a mathematical pairing of softer activity with gently firming price pressures. The coherence score is moderate, and the same 14 of 21 confirmation score sits in a historical persistence band where, in our framework's reading of comparable periods, roughly 41% of similar configurations held over 3-month windows as measured across the 21 series. A record of past behavior, not a forecast of duration. Compared to last week, regime confirmation is unchanged at 14 series, so the framework is still reading a mild stagflation backdrop rather than a new state. Historically, environments like this have felt choppy across broad equity indexes, with more differentiation between sectors and uneven performance across bonds, especially when inflation momentum is positive and growth momentum negative in the sample. The first signal is the behavior of longer-term interest rates, centered on the 10-year Treasury yield. The engine currently marks the 10-year as green momentum, when its rate of change is positive but controlled, which in plain terms means yields have been drifting higher, not spiking. Markets watch this because the 10-year Treasury acts as a benchmark for discount rates and long-term funding costs. When it grinds higher, the question for investors is whether valuations across equities, real estate, and credit still feel comfortable against that rising hurdle, or whether duration exposure feels heavy. In our framework's reading of comparable periods, this roughly coincided with more range-bound price behavior in rate-sensitive assets over 1 to 3 months. A record of past behavior, not a forecast. What would challenge this read is a clear reversal lower in the 10-year yield that shifts the momentum band out of green. The second signal is labor, expressed here through non-farm payrolls and the unemployment rate. Recent data showed monthly job growth well below consensus and the unemployment rate nudging up, a mix our engine currently treats as red momentum for employment, decelerating job creation with some softening in labor tightness. Markets watch labor because it anchors household demand, credit quality, and the policy reaction function. When job growth slows, the question becomes whether corporate earnings expectations and credit pricing still make sense if wage growth or hiring cools further. In our framework's reading of comparable periods, this roughly coincided with more cautious behavior in cyclicals and a tilt toward quality balance sheets within 1 to 3 months. An observation under our methodology, not a forecast. A renewed acceleration in hiring would challenge this interpretation in the framework. The third signal is credit, captured through high-yield corporate bond spreads, the extra yield investors demand to hold lower-rated debt, and broader funding conditions. With risk spreads recently wider and global credit conditions described as tightening, the engine reads this as red momentum, meaning stress indicators have been moving unfavorably. Markets care because higher spreads often reflect rising perceived default risk and more demanding financing terms. The core question for allocators in these historical episodes has been whether current spread levels adequately compensate for potential loss rates. In our framework's reading of comparable periods, this roughly coincided with more selective issuance and slower credit growth within 3 to 6 months, a record of past behavior, not a forecast. A decisive narrowing in spreads would challenge the current red reading. The fourth signal is equity sector rotation and commodities. Technology and industrials have risen, financials have firmed, while defensives such as healthcare, utilities, and real estate have slipped, and gold and crude oil have ticked higher. The engine currently characterizes this mix as yellow momentum for broad equities, neither strongly favorable nor strongly unfavorable, with dispersion across sectors, and green momentum for key real assets like crude and gold when their rate of change is positive. Investors watch this cross-section because it hints at how markets balance growth, inflation, and defense. The question that tends to arise in similar records is whether portfolios lean more towards cyclicals, defensives, or inflation-sensitive exposures when the macro tape prints mild stagflation. In our framework's reading of comparable periods, this roughly coincided with more persistent sector dispersion and steadier performance from real assets over 1 to 3 months. An observation in the sample, not a forecast. A synchronized rally or decline across all sectors would challenge this reading. On the conditional map, 2 if-then triggers stand out. If the 10-year Treasury yield crosses 4.45% and holds for 5 consecutive sessions, in our framework's reading, inflation composites appear to show acceleration in roughly 9 of 11 comparable conditions. A historical characterization, not a forecast. That sort of move would, in our methodology, strengthen the mathematical case for transitions toward more outright acceleration regimes, purely as a record of how the 21 series behaved in the past. If the Fear and Greed Index drops below 15 and holds for 5 consecutive sessions. In our framework's reading, the regime confirmation score deteriorated in roughly 7 of 9 comparable conditions. A historical characterization, not a forecast. Under our regime lens, that kind of extreme fear persistence has historically coincided with more fragile alignment across the 21 series, which the engine records as reduced confidence rather than a directional call. The map is live. These conditions are being monitored daily across all 21 series. Atlas is the automated rules-based engine inside Given Analytics. It does 2 things in parallel. First, Atlas publishes a view of the macro environment, the macro regime, the confirmation score, and the historical base rates we just covered. Second, Atlas runs a fixed 4-layer mathematical framework: price structure, rate of change, risk regime, and market participation across 407 symbols every trading day. When all 4 layers agree on a symbol, Atlas records it as an upside-aligned or downside-aligned condition under the framework, a reading of how the 4 layers line up, not a trade. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside Atlas. They are separate outputs. The regime does not pick the symbols, the 4 layers do. Members use Atlas to study how the framework has recorded conditions across prior environments, as historical behavior, not as trade selection. Atlas runs the framework. You study the outputs and environment. You decide what to do next. These readings are potential, and educational by design, grounded in historical mathematics rather than prescriptive action. The morning brief is the public surface. The live Atlas dashboard shows the full 21 series regime map, today's mathematical conditions across 407 symbols, and the historical archive side by side. Members study the environment and the Atlas outputs each morning. If you want to track this alongside us, the live view is at givenanalytics.com.